to take question 8 for us. ASAP, sharp.
On April 1st, 2017, Gbasgbos acquired 80% of the equity share capital of Melody in a share exchange of 2 shares in Gbasgbos for 3 shares in Melody. The issues of share has not yet been recorded by Gbasgbos. At the date of acquisition, shares in Gbasgbos had a market value of ₦6 each. Below are the summarized draft financial statements of both companies. Can you please scroll up? At the date of acquisition, the following information is relevant. At the date of acquisition, the fair value of Melody assets was equal to their carrying amount, with the exception of an item of plants, which had a fair value of 64 million in excess of their carrying amount and had the remaining life for 5 years at the date. Using straight line depreciation method, Melody has not adjusted the carrying amount of its plants as a result of their fair value exercise. Sales from Melody to Gbasgbos in the past acquisition period was ₦256 million. Melody made a markup on cost of 40% on the sale. Gbasgbos had sold ₦166.4 million at cost to Gbasgbos of these goods by September 30, 2017. Other than where indicated, profit or loss item had deemed to accrue evenly on the time basis. Melody trade receivable at September 30, 2017 include ₦19.2 million due to Gbasgbos, which did not agree with the Gbasgbos corresponding trade payables. This was due to cash in transit of ₦6.4 million from Gbasgbos to Melody. Both companies have positive bank balances. Gbasgbos has a policy of accounting for earning NCI at fair value. For this purpose, fair value of the goodwill attributable to the NCI in interest in Melody is ₦48 million. The consolidated goodwill was not impaired as at September 30, 2017. Required consolidated statement of profit or loss and other comprehensive income for the period ended 30th September 2017. That's all.
Okay. Thank you very much for that beautiful rendition. So let's just quickly look at the question and look at 2 questions, and maybe we'll run away or we'll continue depending on the back bay. So we have Gbasgbos that is acquiring Melody, and from what we have observed, it is a mid-year acquisition because the acquisition happened on 1st of April 2017. And we have to consolidate as at 30th September 2017, which makes it a media acquisition. So we have Melody acquiring Gbasgbos, Melody. Oh, sorry. Gbasgbos is the one acquiring Melody. Question 8. Gbasgbos acquiring Melody 80% and NCI is 20%. Date of acquisition is April 1, 2017. While date of consolidation is September 30, 2017. Making our post-acquisition period to be how many months? 9 months. 9 months is our post-acquisition period. That's just for us to know, so that when we are doing our adjustment and we need it, we'll not be looking for it again. Having done that, we go to note 2, and note 2 will be to calculate the purchase consideration. Why? Because the purchase consideration we have in this acquisition is a share exchange, and that's why even if you check the statement of financial position, They haven't recorded
Sorry,
it.
you're not able to be each month.
Huh?
You're not able to be 6 months. April to September, 6 months now.
April to September. April, May, June, July, August, September. Don't mind me on the 6 months. I'm not being. Orí mi ti ń ṣe overload floating àbí overloading lọ́dọ̀ ń pè. So we have what? Share purchase consideration. But in this case, we were only given one type of purchase consideration, which is share exchange. So we are given purchase consideration to be share exchange. We understand that for a share exchange consideration, we look at the market value of the parent, and the market value of the parent share is 6 naira. However, the nominal value of their share is 1 naira, meaning the shares were issued at what? At premium. So we need to separate what is the share capital and what is the share premium. So share capital will be what? They said they are issuing 2 for every 3 shares they are acquiring. So that will be 2/3 multiplied by how many shares did they acquire? 80% of how many shares do we have in Melody? We have equity share capital of Melody to be 128 million divided by $1 divided by 1 naira divided by 1 naira. So and that will give us how much? Then the share premium, we will now multiply by 1 naira, which is the nominal value. Then we will calculate the share premium to be what? 80% of the same 128 million divided by 1 naira multiplied by 5 naira. And 5 naira is as a result of what? 6 minus 1. And that will give us how much? Those that have calculators should save me, please. Oh yeah, má jẹ́ kílẹ̀ ṣú bá wa ń bì báyìí. Hello? $68,267 $341 $333. So with that, the purchase consideration will be how much? 409,600. Is it clear? Hello? Please, I need us to be responding so I can know if I'm communicating or not. The next we have, after purchase consideration, is to start looking at each and every of the additional information. Can you guys hear me?
Yes, sir.
Babe, just respond now. Ẹ ṣàánú mi. Ìyàwó àtàwọn ọmọ mi wà nílé, ẹ ṣàánú wọn. Okay, so we have at the date of acquisition, the fair value of Melody assets was equal to their carrying amount with the exception of an item of plant, which had a fair value of 64 million in excess of carrying amount and had a remaining life of 5 years at that date using straight line depreciation method. Melody has now adjusted the carrying amount of its plant as a result of the fair value exercise. So they are just telling us fair value exercise is Okay, what do we have? We'll have what? 1 minute. We have fair value adjustment. That is a surplus. How much? 64 million. 64 million. Then let me just make it easier. We'll debit this to investment in Melody. Credit it to where? Ordinary share capital. We'll debit this to investment in Melody also. Credit it to where? Share premium. While for the fair value adjustment, we'll debit it to PPE and credit it to revaluation surplus. And they told us that the asset had the carrying amount had remaining life of 5 years. So to calculate the additional depreciation that will arise as a result of the fair value surplus, it will be 64 million divided by 5 years. But because the post-acquisition period is only 6 months, we'll do multiply by 6 divided by 12. And that will give us how much?
6,400.
What do you call it?
6,400.
6,400. And that will be debited to where? We debit it to retained earnings of Melody, and we'll credit it to where? We'll credit it to PPE. Can that person mute his or mic, please?
Okay.
Number 4, we have sales to Melody. Sales from Melody to Gbasgbos is the subsidiary that is selling to the parents here. In the post-acquisition period was 256. Now, if they told us that the sales for the year was 256, we would have need to prorate to determine which one would be the intra-group, because it is only the sales within the period of acquisition that will be intra-group. Anyone before the period of acquisition is not intra-group. So we will now say intra-group sales. Intra-group sales. So because we are doing SOPL here also, it's necessary for everyone we are saying retained earnings, we state where they should affect in our SOPL, should affect cost of sales. For our intra-group sales, since they said the old 256 million was post-acquisition, we just have 256 million. The way this question is looking now, it seems we'll just manage dollar and naira together, which will be debiting to sales and will be crediting to cost of sales. Will be crediting to cost of sales. And they now told us that they are marking up the goods at 40%. They are marking up the goods at 40%. And they have sold 166.4 million of these goods. So if they have sold 166.4 million, the unrealized profit will be what? Unrealized profit should be 40 over 140. That is markup to margin. On the portion that is yet to be sold, what will be the portion that is yet to be sold? That will be of 256 million minus 166.4 million. 256 million minus 166.4 million will give us the portion yet to be sold. Then we now apply the margin on it to determine what the profit will be. And that will be how much? That will be how much?
25.6. 25.6.
25.6. 25.6 million. We debit that to we debit it to where? We debit it to cost of sales slash retained earnings of who? Retained earnings of Melody, because Melody is the seller, and we credit it to inventory. We credit it to inventory. So we go to note 6. We have what? Other than where indicated, profit or loss item are deemed to accrue evenly on a time basis. No problem. That's to tell us we have to prorate whatever we need to prorate. Whatever is for the whole year, we need to prorate it. The next one is Melody. Melody trade receivables as at 30th September 2017 included a 19.2 million that is due from Glasgow's, but that did not agree with Glasgow's corresponding trade payables. The trade receivables in Melody, as it is related to Glasgow, should be the same thing as the trade payables in Glasgow as it relates to Melody. But they said it doesn't agree in the books of Glasgow because Glasgow has already processed the payment of 6.4 million that the Melody is yet to receive. So what do? We say for the cash in transit, we assume they have received it. So cash in transit will be the 6.4 million will be the 6.4 million would have been received. So we'll say 6.4 million to be debited to cash or bank and credited to the receivables in the books of Melody. While the intra-group current accounts will now be the 19.2 million minus the 6.4 million, and that will give us how much?
$12,800,000.
12,800,000. So if that gives us 12.8 million, then we'll debit that to where? We'll debit it to the payables account and credit it to the receivables account. Having done that, we can now proceed to the next thing, which is to what? They told us the Glasgow has a policy of accounting for their NCI as fair value. And for this purpose, the fair value of the goodwill that is attributable to non-controlling interest in Melody is 48 million. Don't let us make mistake. They did not give us the fair value of goodwill. Rather, they gave us the fair value of the goodwill that NCI has. The fair value of the goodwill that NCI has. So we'll come back to that. Having treated every other information, we go to our net asset summary. And in our net asset summary, we will have what? DOA, DOC, and PAE. So in our DOA, we have what? We have ordinary share capital or equity share, 128,000 at the date of acquisition, then 128,000 at the date of consolidation. Mr. Acquisition is nil. Then retained earnings, we have it to be what? Did they tell us what retained earnings is at the date of acquisition? No. They will not tell us that because it is a media acquisition and we have to calculate the retained earnings at the date of acquisition ourselves. So we'll just bring that of date of consolidation, 208,000. We'll come back to fill this up. What other thing do we have? We have a fair value adjustment, which is a surplus of how much? 64 million. 64 million. Then that gives rise to an additional depreciation of 6,400, which is at the date of consolidation. Then we have what? Unrealized profit on sale of inventory. which is 25.6 million. 25.6 million. Aside that, I don't think we have any other thing that will affect their net asset. So we can close this, but don't forget we haven't put the retained earnings on the date of acquisition. So we can now go to note 9 to calculate retained earnings at acquisition. And we have said where we have made the acquisition, to calculate retained earnings at acquisition, it will be what they have at the date of consolidation, which is 28,000 in this case, minus what they have post-acquisition. What they have post-acquisition will be 6/12 because post-acquisition period is 6/12 multiplied by profit for the year, which is 96,000. So that will give us what? 48,000. 48,000 minus 208. Minus 208, that should give us 160,000. So if this is 160,000 here, post-acquisition will be 48,000. And that means this will be what? 2,000, 12, 14, 15, 352,000. And this will be what? This should be 32,000.
368,000.
This should be 16,000. 368,000, Abby?
Yes, sir.
Yeah, so that is that. Then we can now go to note 10. Note 10 is to calculate what? Note 10 should be to calculate goodwill. However, because they did not give us NCI fair value, and we are told they are to fair value it. We don't have NCI fair value, so we will not be able to use the full goodwill method. We will use the partial goodwill method. So to calculate goodwill using partial goodwill method, we'll have what? We'll calculate that of the NCI first. NCI goodwill should be value at acquisition, which we don't know. Value at acquisition, we don't know. It will be our balancing figure. Then, ideally, what we would have just said is less their share of net assets, share of fair value of net assets, less their share of the fair value of net assets, which should be what? 20% of 352,000. And that would have given us how much? That would have given us how much?
70,400.
Huh?
70,400.
70,400. So if we less this from the value at acquisition, it should give us goodwill at acquisition. And the goodwill at acquisition, they told us that it was what? The goodwill attributable to NCI at acquisition is 48 million. So if the balancing figure should be 48 million, you would agree with me that that 48 million plus the 70.4 million is what would have given us the opening balance of NCI. That means NCI should have been 118,400. Then for that
Sir,
of the
please, can you come
parent,
again?
normally we calculate goodwill to be what? The value at acquisition less their share of the net asset at acquisition. Now, in this case, they did not give us the value at acquisition, rather they gave us goodwill at acquisition. So what we now did is just to do like a change the subject of formula. So value at acquisition plus minus share of net assets is what will give us goodwill. But since we have goodwill and share of net asset now, what we did was to make value at acquisition subject of formula. So value at acquisition will just be the goodwill plus what? Because that minus is causing this thing, is the change to plus. Minus
Okay.
share of net assets. Is it clear? So
Yes,
that
sir.
is that. Having done that, we have what? We have for the parent, it will be their purchase consideration. Purchase consideration, which is how much? We calculated that to be 409,600. 409,600. Then we less their own share. Less share of fair value of net assets. Their own share of the net asset is also what? 80% of 352,000. And that will give us how much? 281,600. 281,600. And with this, the goodwill at acquisition here will also be what?
48,000.
48,000. Okay. It should be 128,000. So total goodwill, total of the goodwill will be what? This, let this be A, let this be B. A plus B. The total goodwill for the company is what? Is 176,000. 176,000. Note 11. Note 11 should now be NCI. NCI. Value at acquisition for NCI is what? 118,400. Share of post-acquisition earnings. Their share of post-acquisition earnings will be what? 20% of 16,000. And that will be what? 3,200. Since there is no impairment and there is no other adjustment, NCI value on that day will be what? 121,600. Then, note 12, consolidated retained earnings will be Glasgow's retained earnings will be what? Will be Glasgow's retained earnings on that day is 1,132,800. Then share of post-acquisition earnings. Share of post-acquisition earnings will be 80% of 16,000. And that will be what? 12,800. Please confirm my figures. Confirm my figures. 12,800. Aside that, what else do we have? We don't have anything. We don't have anything because all of those things affecting retained earnings here, they are affecting the retained earnings of Melody, not that of Glasgow's. I don't think we have any other thing from anywhere. So the consolidated retained earnings will be 1,145,600. So without wasting our time, you can just say note 13, which is Melody's adjusted profit. Melody's adjusted profit will be, are you guys following me, please? Profit for the year. Profit for the year will be 6/12 multiplied by the 96,000. That is 48,000. Then we bring our adjustment as we have it. Additional depreciation, 6,400. Then unrealized profit, 25,600. Aside those two, I don't think we have any other adjustment. So this will still give us what? 16,000. Fine. So we can now go ahead to do a consolidation. Any question at this point before I go to consolidation? Any question at this point before I go to consolidation? Hello?
No, sir.
Consolidated statement of profit or loss and other comprehensive income for the year ended 30 September 2017. That would be, please, can you guys spare me like, please spare me like 5-10 minutes. I want to just quickly put something in place. Please don't leave. I will just be back before you count in. Okay, so sorry about that break in transmission. Can you guys hear me? So for our revenue, we'll have what? 2,720,000 plus 1,344,000. But because it is media acquisition, we'll multiply that by 6/12 and we'll take out the intra-group sales, which is 256,000. And that will give us how much? Hello? Hello, can anyone hear me?
Yes, you are calculating.
Okay, I just wanted to be sure we are together. Cost of sales, we have 2,016,000 plus 1,024,000 multiplied by 6 divided by 12 minus the 256,000 of intergroup plus the additional depreciation, which is how much? 6,400, then plus the unrealized profit of 25,600, and that will give us what also? Gross profit.
So the revenue, three
Figure
million
I'm
one
keep
thirty six thousand.
3,136,000.
136,000.
Okay, number next, cost of sales. I'm waiting for you guys.
Cost of stays 2,304,000.
2,304,000. And what will be our
Hello, sir.
gross profit? I can hear you.
304,000. 2,304,000.
Yeah, I've written that. What will be our gross profit?
It's 32,000.
What do you say the figure should be?
832,000.
832,000. What about the distribution cost?
Distribution cost 96,000.
96,000. Admin expenses?
Good. 243,200.
Okay. Finance cost?
16,000.
So what will be our profit before tax?
Four seven. Okay, 476,800.
476,800. Then the tax will be what?
172,800
So profit for the year will be how much?
minus 304,000.
304,000. So we will now have profit for the year attributable to owners of gas goods, then NCI. NCI will take 20% of the adjusted profit, which we calculated it to be what? 16,000. And that will give them 3,200. The owners of gas goods will take 304,000 minus 3,200. That will be 300,800. Then we can now proceed to consolidation of statement of financial position. Do you understand? Okay. So in the absence of any question, we can now proceed to consolidated statement of financial position. Which is as at 30 September 2017. And what do we have? Our non-current assets, we have PPE, which is how much? 1,299,200. plus 403,200 plus the fair value adjustment of 64,000 minus the additional depreciation of 6,400. What do we have in total? Then we'll bring goodwill. Goodwill, which we calculated to be what? 176,000. Then current assets, we have what? 512,000 plus 211,200. Then we have unrealized profit of 25,600, 25,600. Then we also have what? We also have cash in transit of 6,004. The cash in transit, we'll be adding it because cash is part of current assets, and we'll be deducting it because receivable is also part of current assets. Then we have intra-group current account, which will be credited to receivable 12.8 million to receive minus 12,800. And how much would that give us in total?
PP is 1,760,000.
PP is what?
1,760,000.
1,760,000. No, okay, 1,760,000.
Current assets is 684,800.
684,
800.
800. So what do we have as the summation? Total assets.
2,620,800.
2,620,800. So for our equity and liabilities, we have ordinary share capital or equity shares. Equity shares, we have that to be what? 320,000. But the new one we acquired during the year for the acquisition is 68,267 plus 68,267. While we now have share premium. Share premium of how much? 341,333. 341,333. Then consolidated retained earnings. Which is 1,145,600. 1,145,600. What's this first one, please? This should be
388,267.
267. So what will be our shareholders fund before we bring NCI?
1,875,200.
1,825 what?
875,200.
875,200. So having brought the NCI, we can now go to non-current liability. 10% loan notes. We have what? 96,000 plus 128,000, and that will give us what? 224, abi? 224,000. Then current liability, we have what? 262,400 plus 150,400, then minus the intra-group current account of 12,800. What do we have?
$400,000.
400,000. So what do we have?
262,800.
2,620,000. 2,620,800.
2,620,800. So that is that. That is that. That is that. So that's that on that question. Can look at the next one. So, any question before we move to the next one? Any question before we move to the next one? There's really nothing serious in this next one. It is almost the same with the one we just finished. I don't think there is much difference between it. Um, uh, it's also a media acquisition. So instead of this, I think we should go back to this question 7, while everybody go home to do question 9 on their own. There is nothing in question here. So who is reading question 7 for us?
On question 7, on 1st January 2008, Bolanle acquired 80% of the equity share capital of Swissco. Part of the consideration was settled by a share exchange of 2 shares in Bolanle for every 5 acquired shares in Swissco. At the date of acquisition, shares in Bolanle and Swissco had market value of $3 and $2.5 each, respectively. Bolanle will also pay cash contribution of 27.5 cents for each acquired shares in Swissco on 1st January 2009. Bolanle has a cost of capital of 10% per annum. None of the contribution has been recorded by Bolanle. Below are the financial statement of both companies. All figures are to be correct. Please help me scroll up. The following information is relevant. 1. At the date of acquisition, the values of Swissco assets and liabilities were equal to their carrying amount, with the exception of Swissco's property, which had the fair value of $2.5 million above its carrying amount. For consolidation purposes, this leads to an increase in depreciation charge in cost of sales of 100,000 on the post-acquisition period to 30th September 2008. Swissco has not incorporated the fair value property increase into its entry financial statements. The policy of Bolanle Group is to revalue all properties to fair value at each year end. On 30th September 2008, the increase in Bolanle's property has already been recorded However, a further increase of 600,000 in the value of physical property since its value at acquisition has not been recorded. On 30th September 2018, Fisco accepted a $1 million 10% loan note from Bolanle. Sales from Bolanle to Fisco throughout the year ended 30th September 2018 had consistently been $300,000 per month. Bolanle made a markup on cost of 25% on these sales. 600,000 at cost Fisco or Fisco's inventory at September 2018 has been supplied Bolanle in the post-acquisition period. Bolanle had a trade receivable balance from Fisco of $1.2 million as at 30th September 2018. This deferred to the prevailing trade payable of Fisco continuing to a payment by Fisco of $400,000 made in September 2018, which did not which did not clear Bolanle's bank account until 4 October 2018. Bolanle policy is to value the NCI at fair value at the date of acquisition. For this purpose, Cisco share price at that date can be deemed to be representative of shares held by the non-controlling interest. Due to recent adverse publicity concerning on one fiscal major product line, the goodwill which arose for the acquisition of Fisco has been prepared by 500,000 as at 30th September 2020. Subscribe in school up. Subscribe in school up. Okay. Goodwill impairment should be treated as an admin expenses. Assume, except where indicated otherwise, that all items of income and expenditure are accrue even throughout the year. Required. Prepare the consolidated statement of profit or loss and other comprehensive income for Bolanle for the year ended 30th September 2018. Prepare the consolidated statement of financial position for Bolanle Group as at 30th September 2018.
Okay, so this is another complete question that will take us to the journey of so that's the next thing. So what do we have? We have Bolanle acquiring Switco. So one good thing about this question is it touches on almost all of the adjustment we can have. Almost all. I did not say on the, but it touches on almost all. So please, once we are done with this, we can go to any past question and practice. And after this question, God's willing, we have just 2 more classes to meet. We want to discuss associate and want to wrap up all our discussion, and we'll call it a time. Thank you very much for your time. So we have Bolanle. Bolanle acquiring Switco 80% also. It is just coincident that both questions tonight are 80%. Nobody say it should always be 80%. Date of acquisition and date of consolidation are what? 1 January 2018, then 30 September 2018. And that's 9 months post-acquisition. So no problem. We'll have what? first thing first, they've given us the percentage of holding, so we don't need to stress ourselves calculating that. But the purchase consideration is a bit crazy. They said part of the consideration was settled by share exchange, and also they will pay a cash consideration, but it is to be paid 1 year after the date of acquisition, which makes that cash consideration to be a deferred consideration. So the first thing, we calculate purchase consideration. So what do we have for purchase consideration? First, we have a share exchange consideration. For the share exchange consideration, we have the ordinary share capital to be what? They said they are settling by what? 2 for every 5. That will be 2/5 of the number of shares they are acquiring. 80% of how many shares does Sweetco have? Sweetco has $9 million value of share at $1 each. So divided by multiplied by 9 million over $1, then everything multiplied by $1, which is the nominal value of the shares. While share premium will be 2/5 multiplied by 80% multiplied by 9 million over $1 multiplied by what? Multiplied by so they told us at the date of acquisition, shares in Bolanle had a market value of $3. It is the shares in Sweetco that have a market value of $2.50. So that means this should be $3 minus $1, which is $2, and that will give us how much?
For the share capital is 28.
28.
Yes. And the other one is 5,760.
2,800. $5,760. Okay. Thank you for that. That first one should have been 2,880 now. Then for the deferred consideration, they said they will pay 27.5 cents for each share they are acquiring. That means the amount will be what? If we convert it to dollars, 0.275 multiplied by 2/5 multiplied by 80%. Since they said they are paying for each share they are acquiring, multiplied by 80%, multiplied by 9 million over $1. Don't forget, 9 million over $1 is giving us the number of shares Sweetco has. 80% of that is giving us the number of shares this person is acquiring. It's giving us the number of shares Bolanle is acquiring. Oh, sorry, the 2/5 should not be there again. It is for share exchange, we are doing 2/5. It should just be 0.275 multiplied by 80% multiplied by 9 million over $1, and that will, into brackets, what? 1 plus R, the rate, the parent cost of capital, which is 10%, 0.1 raised to power. How long will it take them to pay? They are paying in the next 1 year because they are acquiring them in 20x8, January 20x8. They want to pay in January 20x9. That's just 1 year period. And how much will that give us?
1,800.
1,800. So 1,800. And with that, that is all we have for the purchase consideration. What's our total purchase consideration?
10,440.
10,440. So the double entry, this will debit investment in Sweetco, the credit ordinary share capital. This will debit investment in Sweetco, the credit share premium. This will debit investment in Sweetco, and we credit what? Deferred consideration. So the next thing, whenever we have deferred consideration, remember to calculate the discount unwound. That is the discount, the interest that will accrue on the deferred consideration. And in this case, it will just be what? 10% of the 1,800. But because it's not yet 1 year from the date of acquisition to the date we are consolidating, we multiply by the number of months divided by 12. And that will give us how much? Hello?
135.
135. But if you check previous classes, I've already explained to us how we have to go about it. If the post-acquisition period is more than 1 year, calculate the first year interest, you add it to the initial figure, you calculate the second year interest, it is on compounding. So for this, we'll debit what? Retained earnings of the parent, which is Bolanle / their finance cost, and we'll credit it to where? The deferred consideration. Number next is to now look at the additional information. We have what? Okay. There was a fair value surplus of 2.5 million on their property. There was a fair value surplus on the property of who? Of Sweetco. So we'll say fair value adjustment surplus 2.5 million. We do that, we debit that to where? PPE, and credit it to where? Revaluation surplus. But don't let us forget, this is for Sweetco. Then they said for consolidation purpose, the fair value surplus will lead to an increase in depreciation charge, which we should take to cost of sales to the tune of how much? 100,000 in the post-acquisition period. 100,000 in the post-acquisition period. So we have additional depreciation they don't want us to stress ourselves calculating it, so they've calculated it. So we'll debit the cost of sales and the retained earnings of Sweetco, then credits PPE. Then we move to the next one. It said the policy of Bolanle Group is to revalue all property to their fair value at each year end. As at 30th September 2018, the increase in Bolanle property has already been recorded. That is, they factor that into their own account. However, a further increase of 600,000 in the value of Sweetco property, since its value at acquisition has not been recorded. So, aside this fair value surplus we have on the date of acquisition, we have another fair value surplus on the date of consolidation, which is how much? 600. So for that also, we'll debit it to PPE, we'll credit it to revaluation surplus account for Sweetco. However, this will not have additional depreciation because it was done on the date of consolidation. They haven't used this. They haven't depreciated the asset, so there will be nothing like that. So, note 7 will now be what? But don't forget, for that revaluation surplus, since it is after the date of acquisition, it will appear in our other comprehensive income because it is what transpired post-acquisition. So what do we now have?
Group says.
On 30 September 2018, Sweetco accepted a 1 million 10% loan note from Bolanle. That's an intra-group loan. Intra-group loan. How much? 1 million. What do? We recognize it. So we debit it to the what? To the loan notes in their non-current liability, and we'll credit it to the investments in their non-current assets. If you look here, that loan note is this. And it will also be, okay, they even put it there outrightly. So we are passing down entry to cancel it from both places. Now, because the loan was taken on 30th September 2018, which is our date of consolidation, that means there would have been no interest on the loan. But it has been taken, let's say it has been taken before the acquisition. You know, the 10% there is the interest element. So we'll calculate the 10%, but we'll prorate by the 9 months. The interest that is accruable for the 9 months, we will have to go and cancel it from from the finance cost in the SOPL, and also cancel it from the investment income in the SOPL. But because this was taken at the end of the year, we don't have such issue. So that's fine. We move on. Note 8, we have sales from Bolanle to Sweet School is the parent that is selling to the subsidiary here. Throughout the year, had consistently been 300,000 per month. That means we have intra-group sales. However, even though they sold to them 300,000 per month throughout the year, it is only the one they sold post-acquisition period that will be deemed to be intra-group sales. So we say intra-group sales, $300 times 9 months, and that will give us $2.7 million. We'll debit that to sales and credit it to cost of sales. Then note 9, we now have what? Bolanle made a markup on cost of 25% on these sales. 600,000 at cost to Sweet School or Sweet School's inventory at September 30, 20 exit had been supplied by Bolanle in the post-acquisition period. If that inventory wasn't supplied as post-acquisition period, we cannot take it as unrealized profit. But because it is supplied in post-acquisition period, we say unrealized profit. On inventory. What do we have? We have the markup to be 25, so that will be 25 over 125 multiplied by the inventory, which is 600,000. But let's assume they told us 2/3 of it was supplied in post-acquisition period. We would have multiplied by 2/3. But since we don't have anything like that here, what will this give us?
120,000.
120. Sorry, I'm quoting all the figures in thousands. So that should just be 120. So we'll debit that to retained earnings of Bolanle / the cost of sales, while we'll credit it to where? Inventory. Then note 10, we have what? Bolanle had a trade receivable balance owing from Sweet School of 1.2 million as at 30th September. This differed to the equivalent trade payable of Sweet School due to a payment of 400,000 made in September, which did not clear Bolanle bank account until 4 October. So we have what? Cash in transit, 400. We debit that to bank or cash and credit it to the receivables. Then note 11, we now have into our group current account. And that will be how much? 1.2 minus 400. And that will give us how much? 800. The 800 will debit to where? We debit it to payables to eliminate it and credit it to receivables. Okay. Number next, we have what? Their policy is to fair value non-controlling interest. And Swissco share price on that date is deemed to be the representative of the fair value of shares held by non-controlling interest, even if they don't tell us. So far, they've told us the policy is to fair value NCI, and we have the share price of the subsidiary shares. We use it. So fair value of NCI at date of acquisition will be what? Swissco share price on that day is how much? $2.50. And the number of shares NCI will hold will be 20% of the 9 million divided by $1. And that will give us how much? That will give us how much?
4.5.
4.5. Okay. So number next, they said, due to recent adverse publicity concerning one of Swissco's major product airline, the goodwill which arose on the acquisition of Swissco has been impaired by 500,000. No problem. Goodwill impairment should be treated as an admin expenses. Fine. Assume, except where indicated otherwise, all items of income and expenditure accrue evenly throughout the year. Fine. And that is all. So in order not to repeat what we did the other time, retained earnings at acquisition will be what? Retained earnings at the date of consolidation, which is 3,005 minus the profit for the year, 2,000 multiplied by 9/12, which will give us post-acquisition earnings. That should be 3,005 minus what? Or what will it give us
Total
in
2,000.
2,000?
3.5 minus 1.5, that's 2,000.
No problem. So that's 2,000. Having done that, we can now go to net asset summary. So note 15, net asset summary. We have DOA, DOC, then PAE. So we have what? Ordinary share capital, 9,000. 9,000. Then share premium, they don't have. Evaluation surplus, they don't have. Then what else do they have? Retained earnings, which we calculate at acquisition to be 2,000 and at consolidation 3,005. So we'll have that to be what? 1,005. We have fair value adjustments, surplus. So at acquisition, it was 25. 25 nil. Then the additional depreciation 100. So I want to separate it for a reason. 1,4. And this will be how much?
The DOA is 13.5.
5, this will be 14.9. But we later have another fair value adjustment, which is post-acquisition, and that one was 600. Sorry, it doesn't exist at the date of acquisition. So the DOA is still 13.5, but the DOC is
15.5.
15.5, sorry. While the post-acquisition is now what? 2,000. So having done this, note (15), we have goodwill, and goodwill will be what? Purchase consideration. Purchase consideration we calculated to be 10,440. NCI, which is at fair value, and we calculated that to be what? 4,500. NCI is at 4,500. Then we less fair value of net assets. So fair value of net assets is how much? $13,500. So that will make our goodwill at acquisition be how much? $1,440. Then we less impairment. We've been told the goodwill has been impaired. Impairment will be how much? 500. So that makes goodwill at consolidation to be 940. Number 16, NCI. We have value at acquisition. How much? 4,500. Is anyone with me on this call, or I'm doing it all by myself?
We are with you,
We
sir.
are with you.
Okay, that's a bell. Then we have share of post-acquisition earnings. So the post-acquisition earnings we want to share, we'll share profit, which is the 1,004. You take 20% of the 1,004, and we'll also share the revaluation surplus, which is 20% of the 600. So this should be 120. This should be 380. Am I right? No, 280. And that will give us how much?
Sir, are we not adding impairment?
4,009.
Impairment, yeah, that's true. Because NCI was valued at fair value, so they should also take part of the impairment. So share of impairment. You take 20% of that 500, and that will be 100. So with that, what will be their balance?
Sorry. 4,800.
Okay, we have 4,000. 4,000, what do you call it?
800.
800. 800. So if that is 4,800, you go to note 17, and that is consolidated retained earnings. So Bolanle's retained earnings is 6,300. Then share of post-acquisition earnings will be 80% of the 1,400. And that will give us what? Share of impairment, 80% of 500. Hmm.
1,120.
1,120. Aside those, well, what are the other adjustments we have? We have discount on one, 135. Discount on one, 135. Then what else do we have? We have unrealized profit, 120. Unrealized profit, 120. What else do we have? And I think that is all we have. So what do we have as the balance?
6,765.
6,765.
765. Yes.
So one we ought to do, because this question gave us the information, is the consolidated revaluation surplus, because both the parent and the subsidiary are having revaluation surplus post acquisition. Consolidated revaluation surplus will have Bolanle's revaluation surplus. And we have that to be how much? 2,000. Then share of the post-acquisition earnings, that is the revaluation surplus of the subsidiary, 80% of that 600. That will give us what? 480. And aside that, we don't have any other adjustments, so that will give us 2,480. Then we can now proceed to the next thing. This should be note 17. No, it should be note 18. Note 18. So the next one will be note 19. which is switch cost adjusted profit. So to adjust switch cost profit, we'll have profit for the year how much? That should be 9/12 of the 2000. And that will give us how much? I mean the 2000 profit for the year. 1,500. Then the adjustment we have were additional depreciation of 100. Then impairments, because impairment is to be shared by both parent and subsidiary, 500. And that will give us how much?
900.
900. Then note 20, switch cost adjusted total comprehensive income. So we have the adjusted profit to be how much? 900. Revaluation surplus is how much? 600. That brings us to how much? 1,500. So we can now go ahead to consolidate. So we have consolidated statement of profit or loss and other comprehensive income for the year ended 30th September 20x8. So what do we have? Okay, we have what? We have revenue, which is 62,600 plus 30,000 multiplied by 9/12 minus 2,700 into our group sales. Then cost of sales is 45,800 plus 24,000, which is multiplied by 9/12 minus the 2,700 into our group sales plus the additional depreciation of 100 plus the unrealized profit of 120. What do we have? Gross profit. Distribution cost, $2,000 plus 1,200 multiplied by 9/12, and that's all. Administrative expenses. 3,500 plus 1.8 million times 9/12 plus the 500 impairment loss, because they told us to take it to admin expenses. Finance costs 200 plus the 135 of the discount on deferred consideration. Then we have profit before tax. Then we have income tax expense, which is 3,100 plus 1,000 multiplied by 9/12, and that will give us profit for the year. For our other comprehensive income, we have gain on revaluation, and that will be the 1,005 plus the subsidiary 600. We don't need to prorate the 600 because it was only made post acquisition, not throughout the year. Figures.
Revenue is
Oh yeah, I'm with you.
82,400.
Cost of sales 61,320.
82,400 for revenue. Cost of sales
61,320.
cost of 61,320. What do we have as gross profit?
21,080.
21,080. Distribution cost
2,900.
2,900. Admin expenses
5,350.
5,350. So what's our profit before tax?
$12,495.
12,495.
Yes, sir.
What about the income tax expense?
$3,850.
3,850. So what do we have as the profit for the year?
$8,645.
So for other comprehensive income, that should be 2,100. And that means our total comprehensive income will be 10,745. So what will be attributable to NCI from the profit? Adjusted profit was 900. So they will take 20% of that 900. And that will give us how much? 180. Owners of Bolanle will take the remainder of what? 8645 minus 180.
Eight four six five.
I don't understand.
You said 8,645 minus 180.
Yes.
Yes, I said 8,465.
Okay, sorry. It's because the figure is looking transposed. NCI will now be what? 20% for total comprehensive income of 15. 20% of 15 is what? 300. So that means owners of Bolanle will take 10,745 minus 300, and that should be 10,445. So we can proceed to consolidated statement of financial position. So to prepare the consolidated statement of financial position, what do we have? We have the non-current assets to be PPE. Can you guys hear me? 18,700
Yes, sir.
plus 13,900 plus there was an initial surplus of 2,500. And you know why the 2,500 is not showing is because it's at the date of acquisition. So we only use it to calculate our goodwill and stuff. It will not come in. Minus the additional depreciation of 100 plus the fair value surplus at the end of the year of 600. What does that give us? Investments. 10% loan notes. So let's go. That 1,000 minus 1,000. Then goodwill. Goodwill with what? 940. And then current assets, we have what? Inventory. What 3 plus 1 2 minus what? The unrealized profit of 120. Then for trade receivables, we have 47 plus 25 minus 400 cash in transit.
PPE is 35,600.
35,600. The intra-group current account is what? Intra-group current account was 800. So this minus 800. Bank, only the subsidiary has bank here of 300. Number next,
Trade receivable 6,000.
6,000. What's the total assets? Equity and liabilities. We have equity shares.
Inventory 5,380.
5,380. We have equity shares of how much? 10,000. And the new one we use is 2,880. Then we have what? Consolidated revaluation surplus. $2,480. Then we have what? Consolidated retained earnings.
Sir, are we not supposed to add that cash in transit 400 to that bank? Or is not needed?
So who is receiving the cash in transit? Bolanle. And unfortunately, Bolanle bank balance is in negative. It's a bank overdraft they have. So I intend to reduce this from their overdraft balance. If the money had come in for them, it should just have reduced their overdraft balance, not that it will be as a positive figure.
Okay.
Yeah. So consolidated retained earnings, what do we have? $6,765.
Our total assets is 48,220.
48,220. So NCI will be what? 4,800. Okay. Non-current liability, 10% loan notes. We did not bring share premium here. Let me see trouble. There was a share premium on the new issue. I hope you did not forget. Share premium. And that is how much? 5,760. $10 loan notes. We have what? 25 plus 1,000. It's only the 1,000 that qualifies as intra-group borrowing. So we deduct the 1,000. We'll have 25 left. Then under our non-current liability, we also have the deferred consideration, which was 1,800 at the date of acquisition. Then 135 as I put on it as interest. That was 1,935. Then current liability, we have what? Trade payables. $3,004 plus 3,006. We take out that into a group adjustment, 800. Then bank, 17. But because the bank is receiving, we'll be deducting it from this, 400. Because this is a liability. In addition to it to increase the liability, but with this transaction is actually reducing the liability. So current tax payable, what do we have? Current tax payable will be what? 2,800 plus 800, and that will give us how much? $3,600. What is the summation, please? You haven't given me the
48 to
share. What is the it's 48 to 20. What's the shareholders fund? I mean this, the summation of this is what?
27,885.
85.
Huh?
27,885.
27,885.
885.
885.
Okay, that will be that about that. Ladies and gentlemen, thank you very much for your time. I hope we now have a thorough understanding of what group account is all about. And with this, you should be able to solve anything on group accounts. I wish you the best of luck. Enjoy the rest.